Joining us now to talk about going active in large cap growth, concentration risk, and much more is ClearBridge Investments Managing Director and Portfolio Manager, Peter Bourbeau. Peter, why don't you kick us off with your assessment of where we are in the current market cycle and macro conditions? What are some of the headwinds and tailwinds for active large cap growth managers and your portfolio in particular?
I think it's fair to say that the market is trying to digest peak everything, right? You've heard that term before, right? So it's peak liquidity, it's peak earnings, it's peak economic growth, whether that's measured in GDP or another measure. All of the tailwinds are evaporating slowly, and that's fine. I think that's what the market is trying to adjust to. The thing that has surprised us, and probably the market more than anything, just given the sensational returns, is how the Fed and Treasury and probably all central banks viewed COVID as much more of a natural disaster than a recession. And if you look at the unprecedented amounts of liquidity that have been injected into the system, I think it's fair to say that we've seen prices get distorted. At this point in the cycle, one would expect rates to move higher, right? The economy is almost fully recovered. Inflation is here. It's visible, and I think there's some duration there. So people should expect higher rates for the right reasons. And so this ongoing debate is peculiar, but I think it's completely healthy and expected at this point in the market.
Well, thank you for walking us through some of those headwinds and tailwinds. Given this kind of environment, could you walk us through some of your recent positioning moves and near-term objectives, such as increasing up capture?
We have tried deliberately and strategically, myself and my partner, Margaret Petrano, to increase the active share and the upside capture. So what that means in layman's terms is making sure that we participate in some of the big moves higher in the broad indices. And we've done that strategically, right? If you look at a risk bucket for a diversified product like ourselves, you have to steal from one area to kind of fund the other. So generally speaking, we've been underweight in strategy, most of the big FANG names. So the top five that is ever so concentrated. And been deliberate about introducing new names that have secular characteristics, along with a durable franchise when you look out 3 to 5 years. So you look at things like an Atlassian, which is a Sydney-based company in workflow and collaboration. C Limited, which is a Singaporean gaming company that has great exposure in e-com. And fintech, it's an emerging company that you're going to hear a lot more about. Netflix, even, which is not a new company, but the story is starting to change from more of a net add to a cash flow generative story. So these are names that we've introduced to help us capture more of the upside on the big up days. And the other thing that we've done is be a little bit more strategic about the thematic investing. This is something that if you kind of look out 3 to 5 years, a growth investor has to appreciate some of the long tail. So one thing that's happened during COVID, which I think we can all appreciate, right, is this digital pull forward of companies trying to digitize either their workflows or their business practices, their marketing, their HR. And this is a permanent pull forward. Right? Like this is a scenario where we're never going back. And so you look at Salesforce.com and the reasons why they bought Slack. This is a company where the growth rate through acquisition is actually accelerating at this point. I mentioned Atlassian, which is going to be certainly a huge beneficiary. Just the cloud behemoths, the Amazon Web Services, the Azure business of Microsoft, annualizing at call it a 30% clip. And it's probably early days for those, right? Companies are strategically moving from their own data center to kind of pay by the drink. But if you think about also the pull forward of e-com, Andy Jassy, the new CEO of Amazon, mentioned that we've probably seen a 2-year pull forward, also permanent, right, in e-com. The idea that behavior has has effectively permanently shifted to some form of online. Now, so Amazon has flipped this on its ear, omni-channel. So guys like Tractor Supply and Ulta have learned to live with buy online, pick up at store, curbside delivery. So companies on the retail side have to adjust, and some have done it well, some not so well. And I think you're going to see a big kind of separation of that leadership. Mm-hmm. I mentioned Netflix, just the idea of streaming. The concept isn't new. I think what's probably not appreciated is a couple of things. The global nature of how big some of these franchises are going to be. Netflix would probably be 600 or 700 million global subs, which is an astronomical figure, right? If you think about the way that we consume media today. So the best content is accruing to some of these streaming leaders. And that's the part that probably isn't as appreciated as it should be. And then maybe just lastly, in terms of thematic investing, maybe in our generation, we're witnessing one of the great industrial revolutions, and that is the migration of internal combustion light vehicles to EVs. Tesla has started something. He's scared effectively all global OEMs to think differently. And this is going to happen probably faster than anybody can appreciate. If you look at the amount of CapEx that the guys at Ford, Volkswagen, Toyota are going to be spending on this migration, it's hundreds of billions of dollars. Like I said, it's probably one of the greatest industrial revolutions that we've seen in modern time.
Yeah, as you said, a lot of these trends are not new, but they're definitely not going anywhere, even post-pandemic. Now, you mentioned how some of the large cap growth companies really dominate in terms of market cap, and I want to follow up on that. How are you managing concentration risk in the large cap growth space?
It's been tough. It's a great question. This has been one of the more difficult challenges. I've been doing this, managing money for 30 years now. I remember the late 90s. We've never seen a level of market cap concentration like we see today. So the way that we are looking at technology and understanding that the Russell 1000 growth is effectively a diversified portfolio with 450 names. The reality is, if you aggregate all of technology, including the top 5 that we mentioned, including comm services, and then you add in things like Tesla, Netflix, and Amazon, you're close to 70% now of net assets in what you and I would call technology, which is anything but a diversified portfolio, right? The concentration risk is massive. And again, that's not a criticism to the business models, but there is risk with this kind of this closet sector fund. We're trying to maintain a fair amount of balance. We're about 1,500 basis points or 15 percentage points kind of deficient in those top 5 names. And what we've done, and I mentioned this earlier, is we're looking at our risk budget in aggregate and suggesting, can we do better than some of these individual positions, and can we do it with less single stock risk? And so we've introduced a lot of new names in the portfolio. I mentioned Atlassian and Workday and Netflix and Eaton, some med tech names, right, where you're getting active exposure, but you're doing it with significantly less market cap and direct exposure. So the hope is that you can participate, but it's also a risk mitigator, because days like we've seen kind of recently with if you look at kind of the 10-year and how that's affecting growth assets, it's also good portfolio construction. It becomes defensive on the big down days. The thing that we're not doing though is underwriting more of the same, right? So I learned fairly early in my career that last cycle's leadership is rarely current cycle's leadership, and we're mindful of that, right? We understand why some of these companies have been as magnificent, powerful as they have been, right? And extracting these giant profit pools. You're paying more than a fair multiple for some of them. And like I said, I think that we can probably do better and minimize our risk by looking in other areas. And then just the last thing is, it's safe to say that the economy is back to to normal, or maybe as normal as it's going to get for some time. And I think you're going to get a lot broader participation in other areas outside of technology. The thing that tech has done is it's become both offensive and defensive. All of that starts to normalize, and regular businesses and other parts of the economy start to open up. And I think that we're going to get a lot more balance in terms of where returns come from if you kind of look through cycle to towards the end of 22 and into 23.
Finally, Peter, one could argue that fundamentals are fading and other factors like the Fed's balance sheet are impacting markets more than they have historically. What will it take for fundamentals to matter again, and how does that contribute to the portfolio's down capture in volatile markets?
So it's very clear that the Fed's bond buying and manipulating fixed income has contributed to extraordinary gains, and that's I think we can all appreciate that. Those tailwinds are ending, right? I think it's completely natural at this time of the cycle for rates to naturally kind of move higher, right? Economic growth is improving globally, and inflation is here. And if we're right that it's permanent, and inflation does ascend to levels we haven't seen, that the Fed's going to be forced to react. But we need to get back to price discovery. And once we start normalizing to get Fed balance sheet and rates, I think that the fundamental side of investing will become a lot more realistic and fruitful. The other thing where I'm not sure many investors are appreciating, right? And I mentioned just the sheer concentration risk of call it technology and many of the large benchmarks. Balance, diversification, which were kind of dirty words for many years. I think that's going to be an investable theme again as you normalize. Because if you kind of straight line the decline in GDP after going from effectively 0 to plus 30, you kind of connect the dots. You're going to be looking by the end of 22 at 2 to 3% global GDP, which is kind of where it should be after the stimulus wears off. That's not a bad thing. That's just normalized growth in a mature kind of Western democracy. So that's what we're kind of playing for right now. And if we're right, you're going to get a lot broader participation in terms of equity returns. We try to manage in a 3-bucket approach, right? We've got cyclical assets, right, or more opportunistic, right, names that have an internal or external kind of deficiency that they're trying to work through to get to normalized earnings. We have a large stable cadre of investments. And then we've got this more elite or select bucket of those names that are a little bit more open-ended, kind of 20 and 30% revenue and cash flow. We're going to just try to maintain that balance. It's served us well through most market cycles. And then maybe just lastly is just risk management, right? Valuation hasn't mattered over the last 18 months just because of a lot of the distortions in price that we've seen. It will matter, and it's mattering probably right before our eyes right now as we start to normalize some of the inputs. So if you think about the cyclical or opportunistic bucket, right, this is where we're looking for companies that are operating well below normalized growth rates for an internal or external reason. Examples might include something like a Disney, right? So during COVID, obviously the theme park business, right, the cruise business, some of the consumer businesses were deeply impacted. And this is all going on through the transition of Disney Plus and Hulu that Bob Iger, the CEO, started. So even though part of their business cash flow effectively went to zero, the transition was underway. And if you kind of look at the other side, and you have to squint here, you look at the theme park business, right? If you look at the costs that have been taken out, those will be permanent. And so cash flow should rebound quicker. Another name is Advanced Auto Parts, where just the do it for me and the do it yourself for autos was deeply impacted, right? When everything kind of shut down, you look at miles driven, almost went to zero. With a reopening, with transportation coming back, the wear and tear on autos has been dramatic, and so the catch up right, has 100% been a beneficiary of guys like Advanced Auto that just continue to churn out cash flow and earnings, global products or services, generally speaking, high returns on equity invested capital. And these are the names that continue to kind of press their advantage, just given their dominance, by either making acquisitions or managing their cost structure differently. And they've got massive scale with their vendors. And then the elite side of the growth continuum, which would be the select category, would be names like like an Amazon or a Facebook, right, where you're growing through cycle revenue in the 20s and 30s and with commensurate cash flow, right? These are names that clearly have potentially more extended valuations, but the business models are self-generating in terms of how they're funded. And if you look at the out years, the size of the opportunity is much bigger than what's currently accruing.
A lot to consider. Well, Peter, thank you so much for joining us.
Thank you, Jenna.
And thank you for watching. Once again, that was ClearBridge Investments Managing Director and Portfolio Manager, Peter Bourbeau. I'm Jenna Dagenhart with Asset TV.